There are two very different stories being told about the New Zealand property market right now. Prices are barely moving, sales are mixed, mortgage rates have stopped falling, and the recovery many people were hoping for may be slower than expected. That's the story most people are hearing about the New Zealand property market right now. But there's another story showing up in the data, and that story says the recovery's already started. Not everywhere, not evenly, and not loudly yet, but it has started. And for investors, that's important because by the time a recovery feels obvious, the best entry points are often already gone. Let's start with migration. Annual net migration reached 25,200 in the year to February, and that's up 42% on a year ago. And it's more than double the low point we saw in August last year. For a country the size of New Zealand, that's a meaningful shift in demand side pressure. And when migration starts rebuilding, the property market usually feels it before the wider economy does. The next thing to look at is where the recovery is already showing up. Otago's house price index has reached a new all-time high. Not just a recovery back to the old peak, a new high. Southland is up 7.9% over the year, which makes it the strongest performing region in the country. Canterbury's also back close to its previous peak, so the South Island has effectively finished the down cycle and started the next one. The North Island is a little further behind. Auckland is still softer, and Wellington remains well below its previous peak, but that's not unusual. Auckland often takes longer to turn because it's the biggest market and because there's more stock to clear. But Auckland is also where migration pressure tends to show up most strongly once momentum builds. So when we look at the data, the message is fairly clear. The recovery is not evenly spread yet, but it is underway. The part of the story that still isn't getting enough attention is supply. Building consents have been subdued for more than a year. This is an important metric because the homes coming to market in 2026 and 2027 are largely determined by consent decisions that have been made earlier. In other words, the supply pipeline is already being shaped, and right now it looks thin. So if demand is recovering at the same time that new supply is being constrained, the market can move faster than people expect. That's not a bold forecast. It's the pattern the New Zealand property cycle has always followed for decades. Prices stop falling first, migration starts to recover, the South Island often leads, sentiment turns quietly in the data before it turns loudly in the headlines. Then sales volumes improve, prices firm, and eventually the recovery becomes obvious. But by that point, many of the easier buying opportunities have already narrowed. That's why this part of the cycle is really important. It usually doesn't feel like a recovery yet, but the data often starts turning before the confidence does. So what are we watching from here? The key issue has shifted. Earlier in the month, the big question was the March quarter CPI number, and that number is now in. Annual inflation came in at 3.1%. So the question is no longer what will the CPI show? The question now is, do second round effects start showing up elsewhere? And that means we're watching three things. First, the labour market. If wage pressure remains sticky or employment conditions prove stronger than expected, the RBNZ will be more cautious about easing further. Second, migration. One strong annual number might mean something, but a trend signals much more. We want to see whether the recovery in net migration keeps building and whether the composition of migration supports stronger housing demand. Skilled migrants and returning New Zealanders are a stronger property demand signal than student or short-term working holiday flows alone. And third, the 27th of May monetary policy statement and OCR decision. That's the next major policy moment for investors. The April OCR hold wasn't surprising on its own. What mattered was the tone. The Reserve Bank's clearly alert to the risk that inflation expectations might become unanchored. So we'd put it this way. The easing cycle is likely over for now, but that doesn't mean rates definitely rise from here on in. It does mean investors should stop assuming lower rates will automatically do the work for them. So what should investors do with all of this? The answer is not to rush, but it's also not to wait by default. Waiting works when the thing you're waiting for is likely to make the decision easier or cheaper. But right now, that case is weaker than it was 6 or 12 months ago. Prices have stopped falling nationally. Some regions are already moving and migration is recovering. The new supply pipeline is getting constrained and the OCR outlook has become much more uncertain. So the focus should shift from trying to perfectly time the bottom to stress testing properly. For any property you're considering, run 3 scenarios. Scenario 1, mortgage rates stay roughly the same as they are. Scenario 2, mortgage rates rise by 0.5%. Scenario 3, rents stay flat for 6 to 12 months while costs continue to rise. If the property only works in the friendliest version of the future, it's just not robust enough. But if it still works under all 3 scenarios, not perfectly, but workably, then you may have something that can survive uncertainty. And that's the point. The aim is not to predict the OCR perfectly. The aim is to make sure being wrong about it doesn't break the portfolio. And loan structure is key here too. With OCR direction uncertain over the next 2 years, splitting lending across 2 or 3 different fixed terms remains sensible for many investors. Longer term fixed rates are more defensible now than they were a few months ago. But spreading rollover risk is still usually better than trying to pick one perfect term. So the big picture for May is this. The recovery is more visible in the data than in the headlines. It's more advanced in the South Island than the North, and it's happening at a time when the supply pipeline's thinner than many people realise. For investors, this is the part of the cycle where discipline is really important. Don't buy just because the market's turning. Don't wait for the perfect certainty either, because in property, certainty usually arrives late. The better question is not, can I predict exactly what happens next? It's, can this investment still work if the next 12 months are less friendly than I had hoped for? And if the answer is yes, that's where the opportunity may be.